take this opportunity to thank everyone who has joined us. And I would like to say good morning. I hope you're okay. I'll be taking you through the tax planning for today's session. I won't really take much of your time. So I'll begin. And tax planning is a very important aspect of almost all the businesses, because this is meant to actually, as the name suggests, to plan your financial affairs, but now with regards to taxes. This is with regards to the tax payable, the tax liabilities you have. Remember, establishing a business as an SME, however small or however large it is, there's always the taxes, and we all know taxes can't be avoided in any way. You cannot do away with that without taxes. So tax planning, in a nutshell, involves us as companies doing our own internal arrangements and assessments and trying to plan, or rather take advantage of all the eligible opportunities available. This includes the tax exemptions, deductions, tax rebates, and any allowances that can actually reduce our tax burden. Maybe someone will now start asking maybe the aspect of now tax avoidance and tax evasion. So there's a very thin line between actually the three, especially between tax planning and tax avoidance. You all understand they all intend to minimize the tax burden or the tax liability. But then when it comes to the tax evasion, it's more of now taking the crooked way or going against the law. But then the thin line keeps getting thinner and thinner. That's why you're finding the government using whatever channels it has, trying to mitigate or cut off some of the provisions within the acts that actually allow people maybe to take advantage or do the tax avoidance thing. Because there is always a loophole here and there, and that's what the government, through the parliament and all that, they keep adjusting the law here and there. So we will go through. We will start with the employment taxes. We see maybe what are the tax planning or rather the opportunities that we can take advantage of. Employment taxes, it's applicable on employees and directors, and as a company, when you've engaged employees, remember you're eligible to file your pay, remit your pay on behalf of your employees on a monthly basis on any advanced remuneration that they receive from you. So it's your obligation to do that. This does not mean now you have to avoid paying pay, or you have to skip paying pay. You do that, but then using the other opportunities available within the various tax regulations, with the Employment Act being guided by the Income Tax Act, then you'll have a chance maybe to reduce your pay liability or the pay burden. We have, let's say, for the per diem being our first opportunity. This is usually when employees are working outside their usual or normal place of work. When they are out of office, you may advance them some amount here and there to facilitate them to execute their duties outside the office. This may be with regards to the traveling, subsistence, and all that. But then as per the Act, the first 2,000, it's actually the government, or let's say the KRA, the commissioner, has no any intention to know about the first 2,000. This is to mean for the first 2,000 that you will give your employee for working outside the office place or the usual place of work, it will actually not be subject to any tax. So this could be considered as an opportunity. You can imagine in a month, I know there are many different fields of operation and businesses out here where maybe they require employees to be out of office maybe once or twice a week, and maybe almost the whole week. For in a month, that could accumulate to some good amount that can actually go without any taxes. So this could be an opportunity that we recommend employers to take advantage of, and if your employees, kindly consider advancing or giving this information to your employers. Let them be aware of the first 2,000. We have the non-cash benefits. These ones here, they are capped at 3,000. So any benefit advanced to an employee by an employer, provided is up to 3,000, that is 3,000 or less in a month, then it will not form part of the amount that is taxed on the employee. So in a year, that translates to around 36,000. Remember, this is the non-cash benefits, and here it's usually at the liberty. I know there are instances where there may be disputes regarding defining what a non-cash benefit should actually be, but then anything that is in non-cash form, that's what I would argue. Remember, it's at the liberty, or it's actually within your rights to define what actually the non-cash benefit would be in your let's say in your business sector. So provided it's not in cash form, or it cannot be actually substantiated as cash, then it will qualify as an non-cash benefit. We have the insurance relief. So under the insurance relief, we are looking at it at the premium. So when an employee, or rather an individual, in this case it includes both employees and the directors, you do your contributions, or you have your premiums paid to any insurance, let's say, that is actually registered, then the amount, those premiums, they are capped up to 60,000 per year, or rather 5,000 per month, which shall actually reduce your pay liability. However, there are usually conditions for you to get a relief on the insurance premiums paid. So here, the conditions are you must actually demonstrate by availing a certificate from your insurer and the nature or the condition of the policy that actually you are being insured of. You can say there's the name of the insurer, the name of you, that is if you are insured, the type of policy, and the premiums that are actually payable, and the date in which that policy came into effect or commenced. So for purposes of this, we recommend that for those employees who have insurance policies, kindly bring your company to attention that you do have this kind of insurance policies. They be factored in so that they may reduce your pay liability. In essence, that is to mean you might have a higher net pay compared to in an instance where the employer is not aware that you are covered, or you have a policy, an insurance policy in place. And for this reason, there is some descriptions defining, for purposes of insurance relief, what a child is. It includes a stepchild and an adopted child, provided they are under the government age, that is the 18 years, since when the premium was paid. So it's not necessarily for your biological son, but also a stepchild or an adopted child would qualify as a child of yours. Just while still on the same, starting 1st January 2022, we have the NHIF contributions will also be included under such insurance. They also qualify for insurance relief. Then we have the tax rebate on apprenticeship, which you also mentioned yesterday regarding it's been extended to TVETs, and it begins next year, 2022, January 1st January 2022. But currently, you qualify for a tax rebate when you do engage at least 10 university graduates. You do qualify for a tax rebate that is on the pay that is deductible for these particular individuals or graduates. And for those who are actually in the TVET sector, it will be, I know most of you will be earning for that 1st January 2022, because it's not many businesses that actually maybe get to engage the university graduates. Many, we understand, the small, the startups, the medium enterprises, they would engage the TVET products, that is the graduates, or let's say those who actually are graduating from these technical institutions. We have pension contributions. If you do make a contribution to a registered pension scheme on behalf of your employees, then this is actually allowable, and it's limited to, or it's capped up to 20,000 per month. In a year, this translates to 240,000 per annum. So we actually recommend companies, either small or medium, for purposes of this, kindly consider registering your employees or making contributions on their behalf to any registered pension scheme. It is not just for their own sake, but it is also a way, or rather an opportunity, that you can act on in order to reduce the pay obligation or the pay liabilities among your employees. Then you have the mortgage interest. This is basically the interest payments on loans borrowed by employees for purposes of improving or constructing any residential premises is deductible. This is to say that for those employees who maybe they do have an agreement with a bank for financing a mortgage, those interest payments that you do make, kindly make them known to your employer. For your own good, they are going to reduce your pay liability. What you should take note is that this is capped to 300,000 per year, and if you are to do per month, that is translated to around 25,000 per month. So at the end of the year, when you are computing your returns for your individual returns, then you are allowed to claim this much, up to 300,000 per year, for those people who have the mortgages. It's not necessarily a new residential premise, even if you are doing improvement in this case. So provided it's serviced and you are having those interest payments, then it's allowable to a maximum of 300 per year. We have the mileage allowance, which is usually a very interesting bit. In this case, when the employees, not just the directors, both the employees and the directors, make use of their personal cars or vehicles for official purposes or for reasons for the company, for any missions or objectives, field work and all that relates to a company, then if a company has a mileage policy in place, there is an allowance that is actually given out for them, a mileage allowance. However, in this case, the company should actually have a mileage policy in place. You do not just say this is a mileage allowance when you have no any policy guiding or providing on how these allowances are given out. But if that is in place, this mileage allowance is actually allowable. And usually, they recommend the use of the AA rates. So let's say for a staff who has maybe your car is up to 15,000 cc, 1,500 cc, rounded off you have 42 shillings per kilometer. So you are seeing what you can recover in a kilometer you cover outside the office place or the workplace while using your own personal vehicle. So this is to mean for the directors who maybe they have an issue, maybe we encounter these issues from time to time, directors having vehicles and then they have an issue using that for company purposes. They do not know how to regain or claim back the money. For this reason, this can be a good way for you to recover your money in a clean way. That is having a mileage policy and utilizing that to claim your mileage allowances. Remember, you have to support it fully. If you are not supporting it fully, this is to mean should you not support fully and maybe there is an intervention by the KRA officers, actually you will have to pay tax on that amount. So you support it fully. If there's any, let's say, those receipts and all that, do use them, support them fully. You have those logbook that maybe you have to show it's your car, then you have those kilometers covered, maybe take note of the odometers and understand how much you covered outside work for that particular official duty using your personal car. Those are just how you are going to support for your mileage allowance. So in a nutshell, what we are saying, you need to have a per diem policy. This will guarantee you at least 2,000. A mileage policy where when it's in line with the AA guidelines, where you are seeing this table, it means there's some amount that you can actually claim as mileage allowance when you work outside the office using your own car. Let's say you take use of your motor vehicle. Then you are seeing the aspect of the non-cash benefits capped at 3,000 per month. Then we have the pension schemes, the contributions made to pension schemes. This is one way to take advantage of this. We have the insurance policies capped at 5,000. Remember, NHIF shall also be included on this. And we have the mortgage interest, looking at up to 300,000 per year. When we are to look at a normal computation regarding this matter, using an estimate of, let's say, a basic pay of 400,000, and maybe in that particular month, you used maybe 15 days out of office, that is 2,000 per day, giving you around 30,000 in per diems. And as per your mileage policy, maybe you qualify 61,000 shillings, maybe you covered 61 kilometers and all that. And then you are seeing a non-cash benefit capped at 3,000, and you have some pension contribution of around 10,000. So total non-taxable allowances in this case, they will amount to 104. So they reduce your taxable amount to 295,800 shillings. So the payee on such an amount is going to be reduced still, and you are having your net pay, as you can see in the computation, on a rise, that is 316. When you do a comparison, that is the pay on the 400 basic pay is quite high, that's 112, unlike it's the case with the non-taxable allowances. So those are just some of the aspects we think they are proper ways, so within the legal framework, that you can take advantage of and try and mitigate the payee obligations. Let's approach to the corporate tax. This is for the companies now. We have the major one, which is the investment deductions. As I had mentioned, we are happy about the 100% idea that was reintroduced the other day. So when you have an investment, a capital intense, that is at least 250 million and above, outside Nairobi City County and Mombasa County, then you can claim the same up to 100%, that is full in 1 year. Then when you have investments in the SEZ, the special economic zones, you are allowed to claim an investment deduction of 100%, that is full amount, should be allowable for your corporate tax purposes. Then there's those heavy or capital intense projects. If in the preceding 3 years your investment value accumulates to around 2 billion or more, then there's the 100% deduction. Also they say, if actually you made an investment having in mind it was for just to claim the 150% that initially was there before the 20th April 2020, the 25th April 2020, when the Tax Laws Amendment Act was passed. Remember, it repealed all these investment deductions, the capital allowances, the whole section was repealed. There were some massive changes. So for those people who had made investments prior to that, and cumulatively it amounts to maybe 2 billion, and you had an understanding or the underlying provision you would claim 150%, now you are seeing the government encouraging the same, and it's actually saying the same shall be allowed onwards. So as much as I understand your SMEs, but if this is on cumulative basis and you feel maybe you're in the manufacturing sector, you understand the investments in such sectors, they might cumulatively get to even 5 billion or above. So there's the 150% investment deduction on the same. Then we have the capital allowances. In this case, we have on commercial buildings, Usually commercial buildings are allowed at 10% per year. And so for those people who are investing in the commercial buildings, you'll be allowed to claim a deduction at 10% rate per year. However, there are usually conditions. You do not just get to claim commercial buildings. In this case, the buildings that are already in use, they do not qualify for this. Remember, this commercial building allowance or deduction was introduced in 2010. That's where this first provision would have worked. However, going onwards, just getting into it, maybe recently you've gotten into this, you've acquired a commercial building this year and it was already in use, please do understand that it won't qualify for this deduction. It's in the first year of use. And this is to mean when you are acquiring one, please understand, try to consult, do a proper due diligence, understand whether it has actually been in use or not. And where the previous owner maybe had claimed, then you will not qualify to claim such commercial building allowance. So the due diligence should give you proper exposure or understanding if actually this has been claimed on that particular property or commercial building you are taking up. Then you have the wear and tear allowance, which most of you are familiar with. There were some massive changes. We remember the rates being aligned to 25% and 10%. This is actually for ease when you use the straight line basis, it will be easier. So the wear and tear allowance is a way that actually may be used by entities to reduce your taxable amount when you are computing, when you are in the tax computation for corporate tax purposes. So we recommend that for companies, please take note of all your capital intense investments. Let's say in the machineries, whatever assets you do have, kindly take note of the same. Do record them for purposes of claiming wear and tear deduction. You'll see some of these are, we have the software, which initially it used to be 20%. Now it's at 25%, which is more of a welcome move to many. So your investment in whatever kind of software you have, please remember you are allowed an wear and tear allowance on the same for 25% on a straight line basis. Computer equipment at 25% capital allowance. Then you have motor vehicles. They are all at 25% capital allowance on a straight line basis. We have furnitures at 10%. Other machineries too, they will be at 10%. So however your P&L looks, remember these assets, the PPE schedule, kindly take note of it, do proper computations, record your costs accordingly, and your acquisition, then do utilize the capital allowances to actually reduce your taxable profit. Then we had the installment tax, which is more of a tax planning. Here, the most important aspect is actually trying to save the cash flow or the financial position of the company. There are instances where you might just start your business and it's just a boom in the first year of commencement. And you can imagine how much tax that would be, considering it's back to 30%. So you can imagine where it stands. In this case, installment taxes, they give you a breathing room. Basically, you are splitting your payments in equal installments. We had a discussion yesterday where you understand it's a provisional tax, and the amount of installment tax that you pay, it's more of an advance tax in this essence, which you actually offset against the final when you are computing your corporate tax or your income tax rate that is payable. So you get to claim such an amount. However, installment tax, it's due on 20th day of the 4th, 6th, 9th, and 12th month. That is just a note for you to take note of. And then it's more of as we had tried to define yesterday, it will be an appropriate tool to try and hedge on the minimum tax obligation. You understand that, yes, the minimum tax obligations have been suspended, but this will be the appropriate way to hedge on it. You understand that it's still an ongoing thing that needs a decision to be made. Maybe the decision will be in favor of KRA. Maybe the decision will be in favor of the taxpayers. In the case that is in favor of KRA and those obligations they will be a company's thing you need to comply with. But when it comes to installment tax, the provisions are clear. It's between installment tax and minimum tax. You have the installment tax obligation and the minimum tax obligation. Whichever will be higher on your computation, it's what will be payable. And understanding minimum tax, we do not get that much of a window to offset the same. It means for installment tax purposes, it will be a better way to hedge on the minimum tax obligation. In a month that the installment tax will be higher than the minimum tax, it means you would not have to pay any minimum tax. So this is just a wait and see thing on maybe the outcome of the court ruling on the minimum tax case. But then this is one of the tools that we understand will come into play in order to hedge on the minimum tax obligation after the outcome. We have the pension contributions. As an employer, those contributions that you do make on behalf of your employees to a registered pension scheme, remember they are tax deductible, in this case for your corporate tax purposes. Yes, we understand there was a cap. They are limited to 20,000 per person in a month, translating to 240. So regarding the number of employees you have and maybe the agreement with the pension scheme, the contributions that you make on their behalf, they will be tax deductible. Just take note it has to be a registered pension scheme and not some sort of scheme that is not recognized by the government. Then you have insurance cover, medical insurance cover. For any medical services, the value that is provided by an employer as medical insurance to the insurance provider, insurance service provider, then it shall be deductible while computing the corporate tax. In this case, you understand the limitations are that this should be made only to the full-time employees. So for part-time staffs, if you do make contributions for such or to a medical insurance or insurance provider, then such will not be allowable for corporate tax purposes. It is limited to full-time employees only. Then we have meals paid on behalf of the employees. I understand this is more of, it's actually limited, it's capped to 4,000 per employee per month. So if a company does provide meals or pays for meals on behalf of their employees, then this cost shall be allowable when computing for the taxable income. In this case, this is 4,000 per employee. Maybe this could boost your employees' motivation. This could actually make their turnaround around work high, so reduce on maybe those costly affairs for people wasting time and improve your production. So we do recommend companies to take advantage of this. Do take charge, cover the meals or the meals cost for your employees. However, this will be capped at 4,000 per employee per month. Basically, this would translate to around 200 bob per day, and if that is your working hours, your working time is Monday to Friday, or that is around 20 days, 200, giving us around 4,000. If you have, let's say, around maybe you have around 10 or 20 employees, you would actually see the amount is substantial. In the end of the year, this could reduce a lot of your amount, or it would eat into your taxable profit, and in the long run you will have a lower corporate tax to pay compared to an instance where you leave all this just for the employees to take charge of their meals on themselves. We have the tax losses carried forward. It was a good thing when the Finance Act extended the same from 10 years to an indefinite period. This is to mean you will be allowed to utilize your tax losses until they are fully finished. So this is an opportunity for many. Per se, this is to mean for businesses, most of the times you will find during their startup course, maybe they do not record the same. And this is what contributes a lot in actually giving a proper P&L position. So you will find you did not record your costs accordingly, you did not claim them, and this is to mean maybe if you are to be in a tax loss position, now you are reporting a profit when the actual position was to be a loss. So we do recommend businesses kindly for all your expenses, provided they are for revenue generation or for the business, do take advantage of the same. Ensure that you record them accordingly, and the tax losses will be a welcome for many. You will have them carried forward until they are fully utilized. We have the other key tax planning opportunities. The tax amnesty that was introduced the other day, the voluntary tax disclosure program. This actually allows companies to disclose their tax returns by coming clean, so on a volunteering basis. So you do come in, you'll be waived on your penalties and interest charges. This is with regards to instances where you are non-compliant, let's say with regards to pay, corporate tax, VAT, any tax head that you felt that you are non-compliant, maybe going on as you are trying to come clean and understand that there is the need for you to do what is right by being compliant. So under this program, after you've made an application to the commissioner and it's approved, then your tax liabilities for the previous 5 years, that is from 2015 June to 2020 July, you might have to come into agreement or a payment module with the commissioner, whichever is accepted. Then there is a waiver for the penalties and interest. However, the payments are the waiver is actually split into 3. You have the full remission on the penalties and interest in the first year, that is 2021. Looking at it, we have less than 5 months in this case. So for those people who still think they need to be compliant, maybe you understand your business might be going big in the upcoming years, and there's a need to come clean. If you think if KRA came on your side any minute, they would actually recover more in terms of penalties and interest together with the principal tax, but then you do not want, you rather hedge on such cash flow, then you have less than 5 months to make your application under this program and take advantage of it for the exemption on such, or for the waiver on such penalties. Then from here, we have the second year. When you choose to make your payments, you have for the second year period, then 50% remission will be guaranteed, that is on penalties and interest. However, if you are to make your payments in the 3 years, that's the final year, the 2023, then 25% remission will be granted on such. The advantage of this is that aside from the waiver being granted on penalties and interest, then you are given a certificate. In case there is an intervention or maybe the KRA officials having a keen interest in your previous years, from the 2015 to 2020, that is the period that this certificate will cover. It means there is nothing they are supposed to do for such particular period. This program is supposed to shield you on that, and that's the reason for the certificate that you will get for actually remitting your taxes on this. You may understand that this is a way that maybe the government may be trying to increase its tax revenue collection, but then a comparison could be done. There is a lot of resources that are put for KRA to actually go on a mission of collecting taxes, doing assessments on almost all the clients. It's one way of giving out an opportunity for taxpayers to come in clean, to understand the need of being compliant. So I would recommend for most of you, It's not too late. As much as I said, maybe have 5 months to enjoy the first year. It's not too late for you to consider this. Engage maybe with your internal people, make a decision, do a proper self-assessment, the same, and then doing maybe an assessment or maybe weighing between your financials and understanding where actually you do stand. You can choose on which year you would have your payments regarding the same to be paid. So I recommend you take advantage of this. If you are an employee, make sure you transfer such information to your employers or the decision makers. It's very key and crucial for compliance purposes. You have the taking advantage of the preferential tax regimes. These are basically the EPZ and the SEZ zones. They are strategically located in areas demarcated by the government for business enabling policies. We understand that these zones, they have an advantage attached to it. Yes, they are supposed to increase production, but then there is easy access to resources, human labor. Then as from the tax perspective, the tax opportunities in these places, they are huge, huge, huge. We have very crazy exemptions that are provided when you are investing in such regions. So I would recommend for most of you to take advantage. Take a look, assess yourself, look at your qualifications. Do you think you can qualify in actually going in these specific zones? As much as they are strategically located, but the government also encourages people to do their hedging and choose whether they can actually invest in such zones. So in terms of corporate tax, you will have an income tax holiday for the first 10 years of operation. And that is to mean for the first 10 years, you will not have an obligation to offer corporate tax, however much profit you do make. And by extension, under income tax, we have the withholding tax obligation, which you will also have a first 10 years tax holiday for the same. For the preceding or the next 10 years, there's a lower rate of 25% corporate tax. That is after the 20 years in total. That's when you will actually switch to the normal rate and be taxed like the other resident entities. Let's approach VAT. When it comes to VAT, VAT is a monthly obligation separate from income, guided by the VAT Act, and it's an indirect tax. And sometimes VAT can be very costly because it requires your cash flow turnaround on almost a monthly basis. So the important aspect here is to understand VAT payable is usually as a result of output VAT, you less the input VAT. That is from your sales, lessing your purchases. So there is the claiming of input VAT, as I had mentioned, from the purchase perspective. Many of you would do this. You do not record your purchases accordingly, but then the sales you do have to because of maybe the issuing of the ETR and all those. So there is the need for you to take advantage of any expenses you incur, the purchases in your line of business. Take note. Do claim all the input VAT. In the long run, this will reduce the VAT liability. And as I had mentioned, for businesses that are maybe commencing, the startups, during that period, you might incur a lot of costs, and yet there is little or you are yet even to break even. Kindly remember to declare your VAT return and declare the correct amount of purchases you incur. Do not wait for long so that you can remember, there is need for you to actually register for VAT obligation. You understand maybe your sales at some point, they will maybe hit the 5 million mark and above. So it's good to take advantage of the input VAT, record it. And maybe another thing by extension is to understand that there is a time limit for input VAT. That is 6 months. It's when you are allowed to claim your purchases. In this case, for those that will exceed the 6 months period, they are time barred. It means you can't claim them. So for the previous maybe 6 months, or less, then such input VAT could be claimable. Beyond that, it means they are time barred. So for those people who maybe you did not take keen note on the same, kindly consider reassessing, do your proper books. This is where the accountants help a lot. Do proper bookkeeping, understand how much purchases you did incur. If they are within the claimable period, the 6 months period, then you can actually, if you did not do a proper filing, you can amend the same and claim properly. There is the time of invoicing, which is a very interesting aspect when it comes to VAT. Understanding today being the 23rd, let's use 23rd, for any invoice you do raise today, 23rd, it means we have at most at least 28 days for us to actually declare that sales output and remit the VAT payable on the same to KRA. This is because VAT is payable on 20th of every following month. So for the invoices issued in the month of July, we have until 20th. In this case, it makes only sense for people who have invoiced at the beginning of the month. They have more time to actually turn around with the proper cash flows to remit the same. Someone may say they prefer raising an invoice at the point that they are guaranteed of payment. Others would say they remit VAT only on the amount received and not on the invoices raised. But the proper case should be consider the 20th of every following month. So declare all your VAT sales of every month before the 20th of every following month. However, you will do a normal scenario analysis where you will see there are those people who actually sent their invoices on 1st of every month. They give you a room of around, if you do make your invoicing on 1st of, let's say, August, you have at least 50 days to declare the VAT and remit to KRA on that particular invoice. So this is to mean that for those people who maybe you do not have a proper planning, kindly reconsider, check on your timing when you can do the proper invoicing, and I would recommend in the beginning of the month. You will see maybe these large taxpayers, they do send their invoices at the beginning of the month because they do understand this. However, it does not mean it's limited to them. However small your business is, this is actually your thing. It's not just limited to the large taxpayers. So it's something I would recommend we take advantage of, re-strategize, reorganize ourselves. Our invoicing model should not just be at any point. What if we did our own internal planning? We do issue our invoices maybe by 10th of every month, and then we have a proper or a humble time, at least 40 days. Even in 40 days, it's a good time for a client or your client to at least find some cash here and there and actually remit, or rather make payments. So we wouldn't say you rather declare VAT upon payment of an invoice and all that. You have a chance. At least 50 days is a good time to turn around on cashing in from whatever invoices you've raised. As I had mentioned also, aside from corporate, we have the VAT, the preferential tax regimes. They're also preferential when it comes to the VAT obligation. So for those SMEs and any other entity that are actually located in this SEZ and EPZ, they gain a lot in terms of VAT. Remember, they will be exempted from VAT. You will see a ton of many tax opportunities that are tagged along the SMEs and the EPZs. In terms of VAT, remember for those purchases you incur while you're in the EPZ, they are actually zero rated. So whatever you incur for maybe for your business purposes, whether it's production, whether it's distribution and all of that, all those costs you incur, they are actually zero rated from VAT. So, and then there is the aspect for EPZ being exempt from VAT registration. Then we have for, let's say for the instance, for excise tax, all the purchases or the supplies we import into these zones, they are exempt from excise tax. And then we have let's say the import duties, they are also exempt. That is the import duties on all the purchases or the importations into these particular zones, they are also exempt. Aside from just the railway development levy, which is actually still applicable, and we understand normally it would be 2.5 to other places, but for SEZ and EPZ, it's at 1.5%. This may be as a result of the magnitude of those purchases that the operators in these zones do actually import. We have the investment deduction, which I had also touched. As a repeat, you have 100% investment deduction on your capital investments. Then we have the income tax, which I had mentioned. Under the income tax, which I had mentioned, the exemption for the first year, then for the first 10 years, then for the next 10 years, the 25%, until you come to the normal rate applicable to others at 30%. For VAT purposes, it's important that you keep your records, especially for purchases, because you can only claim input VAT if you can support a particular purchase. It's important to keep all those invoices, all those purchases. Failure to do so, such an amount would be disallowed. This is to mean your VAT payable would increase. So there's this aspect of record keeping. There is need for us to consider investing, if it is in softwares, if it is in manual storage, the files. There is need for us to find a way that is workable around as a company and ensure that these costs are actually recorded and well kept. We have the issuance of credit notes. In this case, for credit notes, we have a time limit for around 6 months. So credit notes, we have to observe the time rule. As much as maybe they are here to rectify maybe a mistake we did with an ETR and all that, they are here to help us actually to claim them for purposes of the VAT, and they are issued against an invoice. So there is need to observe the 6 months rule timeline, because beyond that, it shall not be allowable. In this case, usually the issue would be when it comes to issuing a credit note, people would want to understand, so what do we do for them to be approved and all that? Remember, it's from your end as a supplier and all that. Maybe you are issuing now your credit note against a particular invoice that had been issued. You will need to actually write a reason for a particular reason for maybe why you are issuing that credit note. And then attach the original ETR that is on the invoice, the ETR that was issued. This is the particular VAT element that will be now allowed for this purpose. But then you need to remember the 6 month rule. Beyond that, the credit note shall be disallowed.